Today we are taking a deep look at ExxonMobil Corporation, ticker XOM, and asking one important question. After the company's major production growth in Guyana and the Permian Basin, its strong cash generation, growing dividend, and significant share repurchases, what could XOM realistically be worth through 2026 and 2027? ExxonMobil is one of the world's largest integrated energy companies, with businesses spanning upstream oil and gas, refining, chemicals, specialty products, and LNG. What makes XOM particularly interesting is that this is not simply a bet on higher oil prices. The company's strategy is increasingly focused on producing more barrels from lower-cost assets while using its integrated downstream businesses and structural cost savings to improve returns. The biggest strength of ExxonMobil is the quality and scale of its asset portfolio. In 2025, ExxonMobil produced approximately 4.7 million oil equivalent barrels per day, its highest annual production level in more than 40 years. Around two-thirds of its production is currently connected to the Permian, Guyana, and LNG resources, and management expects this advantaged mix to continue increasing. That matters because low-cost production can remain profitable across a much wider range of commodity price environments than high-cost production. The first quarter of 2026 was more complicated than the headline earnings numbers suggested. ExxonMobil reported $4.2 billion of GAAP earnings, but adjusted earnings excluding identified items were $4.9 billion, and earnings excluding both identified items and unfavorable estimated timing effects were approximately $8.8 billion. Operating cash flow was $8.7 billion, or $13.8 billion excluding margin posting effects, while the company returned $9.2 billion to shareholders through dividends and share repurchases. The second quarter was dramatically stronger. ExxonMobil reported $14.5 billion of GAAP earnings and $14.7 billion of adjusted earnings, equal to $3.48 and $3.52 per share respectively. Operating cash flow reached $23.6 billion, while free cash flow was approximately $17.2 billion. The company returned another $9.4 billion to shareholders, including $4.3 billion of dividends and $5.1 billion of share repurchases. Looking at the first 6 months together gives us a better picture. ExxonMobil generated $18.7 billion of GAAP earnings, compared with $14.8 billion during the first half of 2025. Cash capital expenditures were $13.0 billion, while the company paid $8.6 billion in dividends and repurchased approximately $10.0 billion of common stock. Total debt at the end of the second quarter was approximately $42.4 billion, down from $43.5 billion at year-end 2025. One of the most important parts of the XOM story is Guyana. ExxonMobil's Stabroek Block has already become one of the company's most productive assets, and the fifth FPSO is expected to begin production in the fourth quarter of 2026, adding approximately 250,000 barrels per day of capacity. ExxonMobil expects 8 FPSO vessels to be operating on the Stabroek Block by the end of 2030. This creates a multi-year production growth runway that is very difficult for most integrated oil companies to replicate. The second major growth engine is the Permian Basin. ExxonMobil produced a record approximately 1.6 million oil equivalent barrels per day from the Permian in 2025. Management expects production to reach approximately 2.5 million oil equivalent barrels per day by 2030. The company says its planned production growth represents roughly a 9% compound annual growth rate through 2030. This is important because Permian production gives ExxonMobil exposure to one of the most economically attractive oil regions in the world. Natural gas and LNG provide another layer of diversification. Golden Pass LNG reached first LNG production in 2026, increasing U.S. LNG export capacity, while ExxonMobil continues to develop additional LNG opportunities. LNG could become increasingly important because global natural gas demand is expected to remain significant even as the energy system changes. For XOM, this creates another long-term source of production and cash flow beyond traditional crude oil. One of the less obvious parts of the ExxonMobil story is cost reduction. The company has generated approximately $16.3 billion of cumulative structural cost savings, according to its second quarter 2026 update, and is targeting $20 billion of structural savings versus 2019 by 2030. This is extremely important because every dollar of permanent cost reduction can improve profitability even when oil prices are not rising. ExxonMobil is still investing heavily. The company expects $27 billion to $29 billion of capital spending in 2026, while its broader plan calls for approximately $28 billion to $32 billion annually from 2027 through 2030. The key question is whether these investments generate sufficient returns. So far, management's strategy is to concentrate capital on advantaged projects such as Guyana, the Permian, and LNG, rather than simply chasing production growth, regardless of economics. The balance sheet remains one of XOM's biggest advantages. At the end of 2025, total debt was approximately $43.5 billion, with a debt-to-capital ratio of 14%. By the end of second quarter 2026, total debt had fallen to approximately $42.4 billion, and the debt-to-capital ratio was 13.7%. The net debt-to-capital ratio is approximately 10.7%. That gives ExxonMobil significant financial flexibility during commodity downturns and allows the company to continue investing while returning capital to shareholders. For income-focused investors, XOM's dividend history is a major attraction. ExxonMobil increased its annual dividend per share for 43 consecutive years as of early 2026. The company declared a quarterly dividend of $1.03 per share in the first half of 2026, and management continues to emphasize a growing dividend alongside share repurchases. However, investors should remember that dividend growth ultimately depends on sustainable, free cash flow across the commodity cycle. Buybacks are another important part of the shareholder return equation. ExxonMobil has maintained a plan for approximately $20 billion of annual share repurchases through 2026, assuming reasonable market conditions. During the first half of 2026, the company repurchased approximately $10.0 billion of stock. If XOM continues reducing its share count while earnings grow, earnings per share can increase faster than total company earnings. For my model, I would not simply extrapolate the exceptional second quarter 2026 earnings rate, because ExxonMobil's results remain heavily influenced by oil, gas, and refining prices. Instead, I would use a normalized commodity price assumption and allow the production growth projects to gradually lift earnings. Under a reasonable base case environment, I estimate 2026 revenue in the area of $350 billion to $380 billion, with earnings supported by stronger upstream volumes and improved operating efficiency. This is a model-based estimate rather than company guidance. For 2027, I expect production growth from Guyana, the Permian, and LNG to become increasingly visible in the numbers. My base case model places 2027 revenue around $360 billion to $400 billion, although actual revenue could be materially higher or lower, depending on crude prices, natural gas prices, and refining margins. The important point is that XOM's production growth provides an earnings growth engine even if commodity prices remain relatively stable. My base case estimate for 2026 adjusted EPS is approximately $10 to $12 per share, while my 2027 estimate is approximately $11 to $13 per share. The range is intentionally wide because forecasting an integrated oil company 2 years ahead is fundamentally different from forecasting a software company. Oil prices can change earnings by billions of dollars, so the right way to look at XOM is through multiple scenarios rather than one precise EPS number. In the bull case, crude prices remain elevated, refining margins stay healthy, Guyana production ramps successfully, Permian volumes continue growing rapidly, and LNG contributes more strongly. Under this environment, 2027 EPS could potentially move toward $14 to $16 per share. If the market awards XOM approximately 13 to 14 times earnings, that would produce a potential valuation around $182 to $224 per share. For the base case, I would use approximately 12 times normalized 2027 EPS. Using an estimated 2027 EPS of roughly $12 gives a valuation around $144 per share. But because ExxonMobil has a stronger balance sheet, advantaged assets, significant shareholder distributions, and long-term production growth, I think a reasonable base valuation range is approximately $150 to $175 per share. With the stock recently trading around the mid-$160 area, this suggests that the market is already pricing in a meaningful amount of the company's strengths. The bear case is straightforward. If crude prices decline significantly, natural gas prices weaken, refining margins contract, and geopolitical or operational problems affect production, earnings could fall quickly. In that environment, normalized EPS could move toward $8 to $9, and a lower 9 to 10 times earnings multiple could produce a valuation around $72 to $90 per share. This is why XOM should never be viewed as a completely defensive stock. It is still a commodity-sensitive business. Putting everything together, my 2027 XOM valuation framework is approximately $90 in a severe bear case, $150 to $175 in the base case, and $200 to $225 in a strong bull case. I would place an extreme upside scenario above $225, only if oil prices remain unusually strong, while ExxonMobil simultaneously delivers excellent production growth and capital efficiency. These are scenario-based estimates, not guaranteed future prices. There are several catalysts that could push XOM toward the upper end of the range. The first is the continued expansion of Guyana. The second is Permian production growth. The third is stronger LNG economics. The fourth is continued structural cost reduction. And the fifth is capital returns through dividends and buybacks. ExxonMobil's long-term plan targets approximately $25 billion of additional annual earnings growth and $35 billion of additional cash flow growth versus 2024 at constant prices and margins, while targeting 5.5 million oil equivalent barrels per day of production by 2030. The biggest risk is obviously commodity prices. ExxonMobil can have excellent operations and still see earnings fall if oil and gas prices collapse. Other risks include geopolitical instability, OPEC and OPEC Plus decisions, unexpected production outages, project delays, environmental regulations, weaker refining margins, and the long-term transition toward alternative energy. The company's own filings emphasize that commodity prices can be significantly affected by political events, OPEC actions, alternative energy, and changes in supply and demand. Compared with Chevron, ExxonMobil's key advantage is scale and the depth of its advantaged asset portfolio. Guyana and the Permian provide a powerful production growth combination, while the company's refining, chemicals, and specialty products operations provide additional diversification. Chevron remains a major competitor, but ExxonMobil's combination of scale, production growth, cost savings, and capital returns makes XOM one of the strongest integrated energy businesses to analyze for the 2026-2027 period. So, is XOM a good company? Absolutely. The balance sheet is strong, production is growing, Guyana is expanding, Permian output is increasing, LNG provides additional growth, cost savings are substantial, and shareholder returns remain a priority. The bigger question is not whether ExxonMobil is a great company, it is whether the current stock price already reflects much of that quality. With XOM recently around the mid-$160 range, I would describe the risk-reward as more balanced than extremely cheap. My final 2026-2027 rating for ExxonMobil is hold, accumulate on weakness from a fundamental perspective. My base case 2027 value is around $150 to $175. My bull case is approximately $200 to $225, and my bear case is approximately $90 to $120, depending on the severity and duration of an oil price downturn. The dividend and buybacks provide an important component of total shareholder return, while Guyana, the Permian, and LNG provide the long-term growth story. For a long-term investor, the most attractive setup would be a meaningful pullback that improves the valuation, while the underlying production growth thesis remains intact. The bottom line is that ExxonMobil is no longer simply an old-fashioned oil major waiting for higher crude prices. The company is transforming its portfolio toward lower-cost production, particularly in Guyana and the Permian, while using scale, integration, technology, and structural cost reductions to generate stronger returns. The 2026 results demonstrate the earnings power of this model, with second quarter adjusted earnings of $14.7 billion and operating cash flow of $23.6 billion. For 2026 and 2027, the key numbers I would watch are oil prices, Guyana production, Permian growth, refining margins, free cash flow, capital spending, and share repurchases. If those indicators continue moving in the right direction, XOM has a credible path toward the upper end of my valuation range. But if oil prices fall sharply, the downside can be significant. That makes XOM a high-quality energy company, but not a risk-free investment. Overall, my conclusion is hold at elevated valuations, with stronger conviction on weakness, while the long-term fundamental story remains one of the strongest among the major integrated energy companies.